Hello and welcome to The Note. Back in August there was a lot of talk about a potential emerging markets crisis. Since then we've had some bad unemployment numbers out of the US and a surprise from the Fed, who decided not to taper off QE after all, and the problems in emerging markets have at least abated. But are we merely talking about a crisis that has been postponed rather than averted? With me now to discuss this is our Deputy Emerging Markets Editor, Jonathan Wheatley. Jonathan,
hi John.
Thanks for coming back again. Let's start by taking a look at the way the markets have evolved. What you're seeing with the blue line is how emerging market equities have done relative to the developed world, and then the red line is JP Morgan's measure of emerging market currencies. It seems to me that in both cases you can see that plainly things are not as bad as they were in August, but also there is no great rethinking to the idea that the emerging markets look riskier now than they did at the beginning of the year.
Yeah, that's
What's
right.
going on?
Well, we've heard from a lot of analysts and economists since the crisis in August, and since things have got better, that we need to rethink how worried we are, that a lot of emerging markets, we're being reminded, have sorted out things like inflation targeting that they've put in, that they've reduced their debt to GDP ratios, that they've built up reserves of foreign currencies and so on. So they're in better shape than they were, for example, back in the 90s when the whole emerging universe was shaken up from Asia and Russia and the rest of it. But the chart also reminds us, that back in May when the Fed started talking about tapering, things took a nasty turn and everybody was sold off together. So different emerging markets have done better in getting the house in order, but in a crisis, they all sell off together. It's emerging, so it's risky, so it's got to be sold. The question now is, are we going to see a reversion to the curve to the sell-off between May and August? Probably not, but I don't think we're going to go back up to where we were before. Okay,
now let's take a look at another chart which takes a look at current account surpluses and deficits. One thing that I did find quite interesting about this last sell-off was that it was slightly more discerning than some sell-offs. It was plainly those countries that had an underlying current account deficit that really got it in the neck compared to the others. Names like Turkey and India that you see on that list, and Indonesia, all those currencies took a particular beating. Are those countries still vulnerable if we do get a return to the nerves about currency flight?
I think they're especially vulnerable. I think a lot of people are, in a way, because it's quite easy, focusing on current account deficits. It's an obvious vulnerability when the currency slides, so it causes particular concern, and those currencies, in a vicious circle, did particularly badly. But if you look at the chart, there are some countries that people are worried about that are surprisingly up in what looks like the safe zone.
Like Malaysia,
I would
maybe.
mention Malaysia, exactly, somewhere that has had recently quite a healthy current account surplus, but that is being eaten away. I don't think it's any longer as high as 6% of GDP. And on the other side, some countries that have suffered classically from things like the end of the commodity super cycle, Chile, copper exporter, doing rather badly, but investors are more worried about Malaysia than they are about Chile, because there's a lot more to an economy than a current account deficit, and Chile has been doing far more of not just the macro but also the micro reforms that give solid sustainable growth than other countries that may look better off.
Okay, so where do you think, what do you think could be the deciding factors in which countries might yet fall into trouble? Before, I suppose the critical names that were of the big countries that people were worried about were Indonesia, Turkey, and India. What's going to decide who is going to avoid trouble this time?
I think what will decide it actually is how discerning investors are and what they decide to look at. People do need to look very much beyond just current account deficits. I mean, some countries have been addressing issues to do with that quite well. India, for example, has been making a lot of the right noises about putting macro questions in order. But investors in the long run are in emerging markets because they emerge, because they grow more quickly than developed markets. And I think it's those countries that do the kind of stuff that Chile has done that will do better in the long run, that put together, as I said, the micro stuff, things like labour market reform, that kind of thing, rather than just looking at the stuff that central banks and finance ministers do. Those are the ones that offer the better longer term prospects. The question is whether you want to go for long-term, stable, perhaps boring growth that you might see in bits of Eastern Europe, like Poland, or if you're prepared to sort of ride the ups and downs and go for more adventurous stuff that we might get in Asia, for example.
Okay, Jonathan, thank you very much indeed. It seems as though we continue to have exactly the same issue with emerging markets that we're used to having. If you want to get those long-term growth opportunities that are so inviting in emerging markets, it tends to be the case that you need to be prepared to put up with much more volatility. There's no reason to think that rule has changed.